This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Can I sell a newsletter?
Sure.
Yardeni Quick Takes, folks, and we protect the copyright religiously of our guests. That's rule number one at Bloomberg Surveillance. Yardeni Quick Takes, it comes in your feed, and it's blindingly C.J. Lawrence, short and to the point. And whether you agree or disagree with Dr. Yardeni, it frames and assists you in your equity belief. Why don't you bring in Paul, the guy who tells me I'm living the roaring 20s?
Exactly right. Ed Yardeni, he is the president and founder of Yardeni Research. Ed, thanks so much for taking the time to join us here. I think a lot of people are looking at the economic data we've been getting over the last several weeks, looking at the earnings we're now parsing through here over the last couple of weeks and trying to get a sense of where we go with this market here. How are you framing all that data? How are you putting it in your model and coming out with kind of a view here?
Well, it's been a go-go market. I mean, it just keeps going. Certainly hasn't paused this year. It's been straight up actually since October of last year. We had a bit of a correction from August to October last year, but it's also been more or less straight up with a brief 10% correction since October of 2022. So it's been a phenomenal bull market.
And Tom, for our viewers on YouTube, that is a bookshelf. I have like 3 books on my book. Dr. Yardeni has a bookshelf.
That's every book. Excuse me, the blue button. The blue button is the Detroit Lions button. Thank you. Yardeni's got up there every book Robert Schiller's ever written.
Exactly.
That's what it is.
So, Ed, I mean, one of the things that I think concerns that some people have now is just, boy, if we've gone a little bit too far, too fast over the last 3 to 4 months, because we haven't seen earnings necessarily follow the performance of some of these risk assets.
Well, we've seen earnings turning out to be surprisingly good for the mega cap 8. Those stocks have done quite well, and we've seen, as a result of that, these stocks do very, very well. But overall, the economy is doing very well, and earnings, I think, are going to be something like $250 per share for the S&P 500 this year, and that would be up from $220 last year. And then beyond that, I think we'll see earnings continue to grow into 2025 and 2026. I don't see a recession. I think it keeps going.
Ed Yardeni with us here for the entire half hour. We're going to take a break in the middle of it to pay for Lisa Mateo's Super Bowl gluten-free veggie chips. But other than that, Ed Yardeni with us for this half hour. Ed, I want to frame out the shock 60 days ago where you said we're going to 5,400 SPX. I did the fancy math and got the Dow Jones Industrial Average out to 43,000 on that number. Do you get any sense that there's Schillerian exuberance out there? Are we getting a Robert Schiller, Alan Greenspan irrational exuberance? I don't feel it.
I think we've got exuberance for sure. And then it's debatable whether it's irrational yet. Right now, it looks like rational exuberance. We still have a lot of money just parked on the side, earning money market funds. We got something like $6 trillion just in money market funds. So money isn't exactly pouring out of short-term assets.
Yes, I don't see it.
Market.
Well, just quickly here, is it going to go? Is the money market fund going to support the Yardeni 5,400 SPX?
Well, 5,400, it doesn't look so amazing anymore.
I'll say.
That's why I'm talking about 6,000 by the end of next year.
There we go.
5,400 isn't as impressive as 6,000 by the end of next year, given how much territory we've covered.
Ed Yardeni with us. I can't say enough about his research. It comes in different platforms. Yardeni Quick Takes is worth its weight in gold. It's short, focused, and it synthesizes in his Yale economics, all of his work on Wall Street over the decades, into a call on optimism in the American economic experiment. To wit, and I go back to what I call the Yardeni and Campora low, two giants, Ed Yardeni and the technical analyst Ralph Ancampora, lonely in October of 2022, and to get up to the Dow equivalent 46,000, which is Ed Yardeni's SPX 6,000, is a lift of 61%. Dr. Yardeni, is that a normal lift out of an angst time when everybody's gloomy? Is up 60% normal?
Well, it doesn't come with a money-back guarantee. I mean, we always have risk in our forecasts, and we have to acknowledge that there are risks. There are geopolitical risks. There's always the risk that the price of oil spikes up again. But my base case is what I call a roaring 2020s. It does rhyme with the roaring 1920s. And in this case, I think the technology innovations that are out there to boost productivity are already working. There's a significant shortage of labor in our country, skilled labor, and technology is going to solve that problem.
On productivity, and again, the Mauboussin Callahan Morgan Stanley essay is brilliant. It's February, and it's already my essay of the year. What's that about? Maybe subject to change. But on productivity at Yardeni, it's about corporations adapting.
Right.
There's layoffs, there's right sizing, and that. It's not about cost cutting. What's it about? A new efficiency?
I think it's exactly about a new efficiency. It's technology led. It doesn't mean that people are going to lose their jobs. I mean, there is always churn in our labor market. We are seeing in some of these technology companies cutting back in areas where they just don't see much upside anymore. But I think most of those people are going to find jobs very, very quickly. They're very skilled, and there's a real shortage of skilled workers. I think what technology does is it augments the productivity of workers, and therefore allows for the economy to grow more quickly. The labor force has only been growing around 1% or less over the past few years. And that's all we have to look forward to with real GDP if there's no productivity growth. But companies and businesses and entrepreneurs are aspirational, and they are going to use technology to increase productivity. And it's already happening. Yep. We had an amazing 3 quarters last year. Last 3 quarters, productivity was extremely strong. Yeah. For the year as a whole, it was 2.7%.
And Paul, the world was coming to an end.
Yeah, absolutely. And it was amazing how productive folks were, even from the comforts of their own home. So, Ed, one of the big drivers or one of the big investment themes in 2023, which looks like it's continuing into 2024, is this whole concept of artificial intelligence, AI. It's not just the Magnificent Seven. It seems like every company in the S&P 500 mentions AI multiple times during their quarterly earnings calls. What do you make of this? You've seen technologies come and go. You've seen waves come and go. Yeah. What do you think of this AI thing?
Well, I should really be embracing it as a confirmation of my roaring 2020s outlook. But I don't know. I'm agnostic on it. I want to see more evidence that it actually is making a huge difference. I'm still trying to have a conversation with Siri, and Siri, you can only ask her one question at a time. You can't ask her to book you theater tickets or order dinner for you. So I'm wondering if Apple and Google couldn't get their personal assistants to really be interactive, I'm kind of wondering whether a lot of this may be artificial, but not really intelligent just quite yet. Look, it is a statistical model. It's kind of like when you sit down to write on Word and the thing anticipates. If you write PROD, it says, "Oh, you want productivity," and then you say yes.
I will get it, Paul, out on LinkedIn and Twitter. It is a spectacular Bloomberg Business Week effort by Ashley Vance on artificial intelligence, and they have taken scrolls in the old world. They're all clay. They're like firewood logs, and they're using computers to read the scrolls, which they believe have never before seen classics, like from Aristotle.
Really?
Like from Plato.
That sounds like a big
Like from
story.
Yardeni. I mean, it's a big story. We hope to have Mr. Vance on next week if his people will agree with our people. Continue.
Hey, Ed, one of the things I think a lot of investors have become, I guess, used to or expect, and they expect the tech sector to drive this market, to pull this market higher.
Right.
Is that still the case here? It seems like it with these Magnificent Seven, and if so, is that okay for this market?
Well, there's this perception that it's not a legitimate bull market because it's been very concentrated. It's been led by only 7 or 8 stocks. Whether I like to talk about the mega cap 8 because I watch a lot of Netflix, so I throw that in there with the Magnificent 7. But I think technology continues to lead the way. Semiconductors have been on fire, and I think they continue to do extremely well. But as you sort of mentioned, every company is mentioning AI these days. I think every company is a technology company. You either make it or you use it. If you don't use it, you lose it. You go out of business. You have to use technology. What's really amazing about technology today is it's really focuses on augmenting the brain. It used to be productivity used to be all about augmenting the brawn of humans. Now we're talking about the brain of humans, and the potential of that is awesome.
How do bull markets end?
Badly. I mean, there is a potential here for something, as you mentioned before, of the 1990s. If there's a stock today that reminds me of Cisco, it's NVIDIA. NVIDIA made a lot of money on gaming chips. Then it became Bitcoin mining, and now it's AI. And these are all legitimate sources of income. The stock has been on fire for good reasons. Earnings have been very strong. But Cisco went to the moon and then back, even though it made a lot of equipment for the internet, and the internet certainly survived and thrived. And I think AI will survive and thrive, but I think it's a little bit more hype than is justified for what it can deliver just yet.
Paul, what do you make of that? I mean,
here's what
I love the Cisco warning.
But here's another alum from C.J. Lawrence. I mean, pound for pound, if people don't know, go back and Google that. Pound for pound, that was some of the best research coming out of Wall Street for a long period of time. And C.J. Lawrence back in the day.
It was printed back in the day. Back in the day, folks, it weren't PDFs, and it was tactile, and it was visceral. There was paper, and you had a pencil. And I'm sorry, Paul, I thought that oftentimes I think that's way more valuable. Jurrien Timmer joins us in the studio today. What do the charts say about the Magnificent Seven? Will Danoff has 13% of his portfolio in Meta Facebook. What do your charts say to Contrafund?
Good morning. And by the way, the chart room really used to be like a war room back in the day, preceding even Ned Johnson, but his father, Mr. Johnson. And that's where they would just, strategize, because that was pre-computer screens. And they would sit in that room and just, try to solve the world's problems. So
well, they're doing that at the Eccles building now, and you see how that's going.
Yes.
What do you say to Will Danoff about the Magnificent Seven from your technical perspective?
So our analysts, and portfolio managers, they look for the winners over the long term, right? The next 5-10 years. The way I look at it, and I've studied this extensively, I've looked at the Nifty 50 phenomenon, which started back in the early 70s. So back then, if you may remember, I wasn't quite around there then yet, but after the 68 speculative glamour stock bubble, the market fell 36%. It wiped out retail, and the market was in the hands of institutional investors, and everyone got so burned by the glamour stocks, they just wanted to buy tried and true earnings growers, IBM, Xerox, et cetera, Colgate. And those stocks delivered, but they ended up trading at really an extreme. They ended up trading at twice the market's valuation. So there was a 2x premium. And then, inflation happened. It wiped out valuations everywhere. And they went from 20x to 7x by the late 70s. And then in the late 90s, we had the same thing. Different companies, of course, different players, but that was the dot-com bubble. Again, a 2x valuation premium. The market stayed at 20x, and those Nifty 50 went from 20 to 40x. That bubble imploded on itself. Now we have, again, dominance by, Mag 7, Nifty. I tend to kind of still look at it as Nifty 50, even though there are fewer than 50, but just to be consistent. The premium on the valuation side is only about 30%. It's not the 100% that it was the last two times. So these stocks have now dominated for almost a decade, but it's been mostly justified by earnings. And that's a different take on it.
So, the way I kind of phrase it is just, tech has led this market for such a long time, and I kind of feel conditioned that if tech's not going to lead this market, this market's not going higher. I'm not sure if that's the case, but do you still feel like tech and some of these things have to work for this market to work?
So it's a nuance of overall participation in the market versus who is outperforming, right? So last year we had the record narrowest market. Only 26% of the stocks in the S&P outperformed the S&P. So that's the lowest we've ever seen, and on par with early 70s, late 90s. So the market does eventually broaden. I mean, that's just the mean reversion nature of the market. And I am in the bullish broadening camp for this year. I mean, when you look at, obviously, S&P 5, cap weighted is making new highs. It's at 5,000. But I look at SPW, S&P 500 equal weighted index. To me, that's the most important chart. And that's been sitting below its all-time highs now for like 107 weeks. Wow. But it's like 2% below, right? It's on the cusp. And I do think that history will tell you, right? Market goes up 70% of the time by about 10, 11%. It's the market's inherent nature to go up. So, you want to be a bear with some caution because you're really fighting the odds. So to me, it's a question of the generals are leading the soldiers. Obviously, the market made a new all-time high in January. January was an up month. So these things are momentum builders. So in my sense, the SPW will follow suit. The market will broaden. But that doesn't mean that other stuff will outperform the mega cap growers, right? That doesn't mean the banks are going to outperform. So I don't have a good handle on who's outperforming, but I do have a sense that the market's going to broaden out. And for an investor who might have missed out the rally last year, that's kind of a second chance to still participate.
You guys did sector funds. It was like revolutionary. Select funds. It was revolutionary. People thought you were nuts. Oh, this can't do this. It breaks prudent man rule. People over at Putnam, their heads are spinning. They can't do that. And now it's one big sector ETF. Jurrien Timmer on how we're handling passive and active ETFs. Forget about Bitcoin and all that. Just for mere mortals like me, we've become one big select fund, haven't we?
It depends. I mean, there's a fund for everyone, right? I mean, there's many of them, and now even in digital assets there are options, and I'm very proud of our team and how well we've done in terms of launching.
You think BitDog's a legit asset?
But but it's a question of portfolio allocation and having blunt instruments versus surgical tools, and it's good to have the options, and they're not for everyone. I mean, for many investors it's fine just to buy some S&P or some MSCI EFA or World XUS, but others want to get more specific, and so we can go value, growth, small, large, US, non-US, developed, emerging, and there are areas where you want to be nuanced, like in emerging markets. They're not all created equally, and so you want to be discerning there.
What's the biggest mistake, 30 seconds, what's the biggest mistake people make in technical analysis?
They don't backtest the indicators. And they lose the context. Because without context, they're all a coin toss. And so you need to have a thesis saying, okay, this is a consolidation in an uptrend. If you don't make that assumption, you can never get around assumptions in our world, even though they make asses out of you and me. But you need to have some context around the indicators, otherwise it's noise.
Could you see Belichick running money at Fidelity?
Oh, yeah.
I mean, you can't get a job coaching football.
Oh, no, you can get an office downtown.
The Belichick Fund?
Sure.
At Fidelity, it works. Jurrien Timmer from Boston, thank you so much.
Another bastion
I can't say enough
all over the place
about his technical work. Look out on LinkedIn. It is the best technical work on LinkedIn. Jurrien Timmer, Timmer. Can't say enough about it. There's something here we haven't done recently. It's just been off the news radar. And that's a shock when you see what's going on in the Eastern Mediterranean. As President Biden mentioned as he walked back to the podium yesterday after the end of the press conference, there's some geopolitical risks out there. And it gets you, as Lisa was mentioning, the oil prices elevated, NYMEX 76 a barrel, Brent crude $82 a barrel. Exquisite on this is Amrita Sen. We're thrilled that she joins us right now. Amrita, you're just wonderful on the supply and demand dynamics. Which is most interesting right now?
I'd say supply for two reasons. We've had supply surprise to the upside last year, particularly U.S. supplies, and that's what caused the correction in prices. Now, what we're seeing is actually the market having tightened up more than people had expected. We've had inventory draws, unexpected inventory draws in January, probably looking like small draws in Feb as well. Not that the Red Sea has caused supply outages, but it is creating a lot of stresses and strains on the supply chain. From where you sit, I understand it's a global basis, but is a liter of petrol or a gallon of gas, is it going to be elevated over 2024? Yes, it will be much more than crude will be. It will very much be petrol prices and gas prices because of what we're seeing in the Red Sea. Shipping costs are very, very elevated. And what happens is therefore delivery of all these products that we consume is just going to get more expensive. And therefore, we're going to have to pay more at the pump.
So what's the outlook here, Dr. Sen, on demand here? I know, when I talk to energy folks like you, I know you have to have a clear view of not only supply, but demand. I mean, I look at the European economy is a little bit weaker than people would expect. China weaker than people would like to see. So what's the demand outlook?
I would say demand is okay. It's not like, last year we had 2.2 million barrels per day of demand growth, in part because it was a post-COVID recovery in China. This year we're calling for 1.4, but we have raised it. It has been coming in stronger than expected, particularly in the US. Europe, if anything, it is bottoming out. China is the worry, right? And Chinese demand hasn't been great. The property market isn't great. But again, we are not expecting much out of China. We're expecting about 500,000 barrels per day of growth out of China. So it's in our numbers, but that would be very much the worry right now.
And on the supply side, the U.S., I mean, we're not used to being net exporters of oil here in the U.S. And I don't see any, signs that some of these producers are pulling down production. How do you view the U.S. as a supplier?
Oh, the U.S. is continuing to grow. And yes, we had a bit of a setback because of the freeze-offs. But the reality is that we we expect to see continued growth out of the U.S., even if it is kind of gradual increases this year. Growth rates should be a lot slower than last year. Last year, it was also boosted by M&A activity. So we're expecting about 500,000 barrels per day of year-on-year growth in crude production this year out of the U.S. versus close to 1 million last year. But still, definitely growth.
So a term that we used to talk about a lot when talking global energy was peak oil. I don't hear that very much anymore. How do you think about that big theme there?
Depends on whether it's peak oil supply or peak oil demand. I think people now talk about peak oil demand a lot more, which is also not true. I've never believed in peak oil in the sense that we always have enough reserves. It's always about the price. At what price do we exploit those reserves, right? We're not going to run out of oil. But if it's at $50 oil, $50, you're not going to exploit that. It's more that exploration's getting more expensive. That's the point. Demand equally, the IEA keeps talking about peak oil demand, but that hasn't been the case. And if anything, demand keeps coming in higher and higher.
Yep.
Well, demand comes in higher and higher, but the great theme for those over $100 a barrel 2 years ago was a Pacific Rim lift that just basically developing economies, I guess they care about climate change, but they're saying, let's go. And you get an EM demand. Is that still there?
Oh, EM demand is still very much there. I just got back from India today, and I was there for India Energy Week, and it was absolutely massive. Like Indian demand, India is very much on the path that China has been in the past couple of decades ago. Southeast Asia, and then there's Latin America, Africa. Yeah, absolutely. EM demand is very much there. But equally, OECD demand isn't really falling either.
So how's the energy going to be there? The energy usage in those developing markets, how much of it is going to be fossil fuels versus maybe greener energy as those markets develop?
They of course want to not create pollution if they can, but for them energy security and energy affordability ranks above anything else. India is really pushing hard for EVs, but not because they want to get away from petroleum. It's because coal is their cheapest and most secure form of energy. EVs there will be fired by coal. I don't think it's going to actually reduce emissions. So I think we need to be very pragmatic when we talk about energy transition. I continue to believe it's a very privileged Western concept when you don't have basic electricity electricity, you are not actually going to care about whether the electricity is going to be green or not.
Amrita, thank you so much. Greatly, greatly appreciate it with the energy aspects. Today's front page. Put the terror chips down. Give us the headlines. What do you got?
All right, since we're talking food, we might as well go there. We're talking about the Super Bowl, how much people are spending at home. This is from the National Retail Federation. Okay, Americans plan to spend $17.3 billion on the Super Bowl.
Nice.
That is up $1 billion from last year. Okay, 80% of that, food and drink. There's also apparel,
Wings.
decorations, things like that. But why is it so much higher? Here's the thing. You have this new demo coming in. You have the Taylor Swift crowd coming in. So now they want to have their own parties. They're pumping up spending as well. And it's changing what people are eating too for the Super Bowl. So usually it's burgers, barbecue, like that kind of thing.
Yep.
Now the top three items, wings, which is still up there, pizza, salsa dips, and spreads. Because apparently women like that better.
Okay.
They think it's a staple. You got to always have chips and salsa.
There's a Swift angle to everything.
There's a Swift angle. Yes, a new demo.
Okay.
So the younger ones are having their own parties, boosting
Is
spending.
she like in the locker room? I mean, she's like up in the cheap seats, right?
Yeah, I mean, and she's
If she gets there.
jetting in from Tokyo.
Next.
All right, here we go. World Cup finals, because Paul, you mentioned this yesterday. This article stood out to me.
Oh, this is English football.
Yes.
Yes, you like this. It's coming to MetLife, as we know, but how did the fans get there? So you asked this questions yesterday. New York Times has a couple things. They have about 2.5 years to figure this out. But it was home to the Super Bowl in 2014. If you remember that, traffic was a nightmare. It didn't
Always
work
is.
out very
Always
well.
is.
Yes, it did handle 3 Taylor Swift concerts okay. But here's the thing with the Meadowlands. No direct trains, like you mentioned, to New York City from the state to the stadium. The nearest transit hub, Secaucus Junction.
Yep.
That's a few miles away. And it's been known to sit in traffic. It's a given. You know, when you go on the turnpike, you always gauge around when is the game, who's playing, Jets, Giants, home. So that's the problem. Here's what they do. State legislators, they allocated $35 million. They're going to design a dedicated transit system similar to like the Disney World's bus system.
Really?
And on game days, those buses are going to travel along the back roads that's currently closed. And it's going to dedicate lanes on the New Jersey Turnpike to these buses, too. So that's
All right, that's
apparently
a
how they're
plan,
gonna
but
do it.
here's my plans for our worldwide
Yes.
audience listening. This is from a native New Jerseyan who goes to MetLife Stadium for
Yes.
Jets and Giants games. Just take New Jersey Transit. I'm telling you,
There you
it's the
go.
best way to go. It's 10 minutes from Manhattan to Secaucus.
Yeah.
You switch at Secaucus, and the train is 5 minutes to MetLife Stadium. Yes, you have to wait
that-
coming back a little bit, but you've already had a couple
It's
of
easy.
beers.
Am I
it's fine.
right? When is the World Cup? Like, is it not
like
this
2.5
summer?
years? Yeah.
2.5 years away.
26, yeah.
Ferro says this is like a ginormous thing. He says America's not ready for this.
People
It's
coming from
huge.
everywhere.
Everywhere.
Yeah.
Yeah,
everywhere.
and it's like I don't know, it's all over the
And
country.
I don't know if they know
I mean,
that
John
it's in the middle
talks
of the
about
swamp.
this all the time. We're having breakfast or something. You know, we're over to St. Regis putting down, good morning, Redo, keeper of the Amex. And, you know, I'm putting it down with John. We're just building up a $200 tab. I don't even listen to the football talk.
No.
I mean, you know, but the World Cup's going to be ginormous.
Yeah.
What else? This is great. What else do you have?
Okay, Tom, you asked this question yesterday, so I found this out. Why PayPal is struggling?
I don't get it. Now, firm's out today as well.
Yeah, so the Financial Times did a look into this. Apparently, there's a Gen Z problem. Okay, the younger generation, they like to pay with the click and their phone. You know, they just like to click and tap, and that's what they like. So they like Apple Pay. You know, they like
that's
those
what I use.
autofill payments. They like buy now, pay later services like Affirm and Afterpay. They like that. 3/4 global iPhone users used Apple Pay in 22. Nearly 1/3 of them were between the ages of 18 to 29. So you see that big group there. 50% who prefer PayPal, well, they're 45 years and older. So that's a group. And PayPal, I didn't realize, but they do have Venmo. But the problem is that they can't monetize it because you can't charge people to use Venmo because Zelle's for free.
Well, it's competitive
It's
and
very
all that.
competitive.
I mean, Brian Moynihan's been very clear on this of Bank of America, the earnings, the Zelle growth they feature in their PowerPoint when they come out with their earnings. It's
great.
This whole digital thing, I'm still writing checks at home. I'm the last person.
Really?
Yeah, I dipped a quill in.
I
You know.
kind of forgot how to write a check.
I got the old fart checks for the blind. You know, they're great. And, you know, you put only, and, you know, that I'm not going to do Venmo to write a tuition check, you know.
Oh,
I mean,
they
this-
make it so easy to pay tuition.
Oh,
It is-
they do now,
Yes,
do
they
they?
do.
Penn State
Yes.
University was the absolute best. They were on par with Amazon. Literally one click, and then 25 grand whoosh, right out of your account. One click.
Yeah.
They know what they're doing.
It's a whole new world after all. Taylor, go back and have some vegetable chips. Taylor, Lisa Mateo.
The Terra ones are good.
Lisa Mateo, thank you so much. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.